Good afternoon, everyone, and thank you for joining us today for the next webinar in the Chart Chat series. My name is Veronica Miller, and I'm a departmental analyst at the Community Engagement and Finance Division at the Michigan Department of Treasury, and I'm going to be your host for today. Before we begin, I'd like to go through a few details. Today's webinar has a question and answer feature. To access this feature, click on the Q&A button, type your question, and click the send button. There may be many questions today, so please wait until the presenters are done with their presentation before asking questions about that topic, as many of your questions will be answered with the material being covered. We may not be able to get to all of the questions today, but we will definitely do our best to cover as many as possible. Over the past several months, we've had many webinars, that have covered a diverse set of topics important to local governments. To view previous webinars and other resources, please visit Treasury's Local Government and School Services webpage and the COVID Updates and Resources for Local Governments webpage. We will be posting those links in the chat box momentarily. If you would like a copy of today's PowerPoint to follow along with during the presentation, we will also post a link in the PowerPoint in the chat box. It is now my pleasure to introduce our first speaker of the day, Mike Forward. Mike is the Audit Field Manager for the Michigan Department of Treasury, and today he will be speaking with us about common audit deficiencies and how to correct them. Mike?
Thanks, Veronica. So I guess I kind of focus these slides around smaller local units of government and more or less focused on capital assets, the deficiencies that we find related to those. I'm starting off here with the GASB definition of a capital asset. I'm going to just kind of focus in on the last part here that says that have an initial useful life extending beyond the reporting period. Reporting periods for governments in Michigan are generally 1 year. That's kind of the threshold that we use from a time frame perspective to determine if something's a capital asset or not. If you could go on to the next slide. So this is an example of a non-compliant capitalization policy that we see fairly often. What they'll want to do is use the estimated useful life in excess of 5 years here. They've got several different useful lives here that they're using as a threshold, which is kind of, well, it is in violation of GAAP there. The problem happens here when you see capital asset that's over your threshold but under the useful life. So if you were to get a truck that you thought was going to last 5 years, and it was a $100,000 truck, based on this policy, in a smaller local unit they may not capitalize that, and that would create a material misstatement for the financial statements based on the policy. Next slide. So obviously the issue here is the policy didn't conform with GAAP. You want to create a policy that doesn't contradict that. And if you want to avoid expensing or capitalizing items, just set the threshold higher for your capitalization policy. Next slide. Another issue that we see, a capitalization policy doesn't exist. Go out there and create one. Chapter 10 of the Accounting Procedures Manual issued by our department provides a lot of information on capital assets. Next slide. So another issue that we have, capitalizing items below the threshold. Generally, you see counties making purchases or local units making purchases, large purchases with many small items. This one it happens quite often. You have the option to capitalize a group of assets under GAAP, but you're expected to track those assets if you do that on an individual basis. Many times we don't see that. Next slide. So clearly having a capitalization policy, you know, using an individual amount. So, you know, the previous example had $700 per item. Using that to make the determination whether to capitalize or not. Generally speaking, that's probably a better policy to use. Determining whether it's individual price versus a group of assets and expensing those off. Or you have the option to keep track of the individual assets when they're capitalized, perform an inventory of the assets yearly, book impairments, and remove assets when necessary. Next slide. Assets not being capitalized, that's another issue that we see. Police department may buy like a police car and they'll capitalize the car, but they won't capitalize all the other items for the car, light bars, radios, decals. Next slide. So yeah, another solution here, you know, keeping a file with all costs associated with the construction of an asset, you know, and having the purchasing departments clearly communicate with the finance department. Next slide. Depreciating capital assets, it's common for local units of government, smaller local units of government, not to calculate depreciation. Using a Excel spreadsheet, you know, with the asset type, government-wide classification, useful life, current year depreciation, accumulated depreciation, and net book value. Those are really useful, you know, to give to your auditor when they show up. You know, that helps out quite a bit. You know, Excel formulas can be used to automatically update these. Next slide. And so here's an example of a sheet that I created. You know, all that I need to do here with this sheet is change the highlighted cell up in the left-hand corner from 12/31, 2026 to 27. The sheet will just automatically roll the depreciation based on formulas. You know, if you're not that savvy with Excel, it would be just as easy to type this in and keep track of it that way as well. Next slide. So another common issue, assets no longer used in operations. So they're not removed or they're obsolete. You know, the backhoe that, you know, that was decommissioned 3 years ago is still sitting in the back lot. It doesn't run, but you still got it. You shouldn't be recording that on your books because it's not currently used in operations. Having written procedures for the removal of assets, that's a good idea. Performing a physical inventory of capital assets yearly or biannually to identify assets that have been removed. Or you could possibly perform a physical inventory of fully depreciated assets. That's an audit procedure that we use when we're looking for assets that may need to be removed from the books. So just some ideas there to help with that issue. So I think that's the last one of my slides there.
Great, thank you, Mike. Our next speaker for today is going to be Kerry Vaughan. Kerry is the manager of the audit section at the Michigan Department of Treasury, and he'll be sharing information about how local governments should record revenues from the American Rescue Act.
Hello, everyone. Kerry Vaughan, like was said, I've been working for Treasury for quite some time now, and I'm happy to talk about the American Rescue Plan Act with you. We have a first poll of the day. If you take a look at your screens, we'll give you about 30 seconds to answer that poll. Has your local government ever filed a single audit in the past? We're thinking in the future that's going to be a little different now that we've got all this money coming in. So we're kind of wondering what it's going to be like. So what is it like with you? Give you about 30 seconds for that. All right. Looks like about 62% of you have, and 20% have not, and 20% not sure. So that's about how I would guess. So very interesting. Thank you. Go to the next slide. Okay, so I'll call the American Rescue Plan Act ARPA. I'm thinking that's probably what we're all going to call it in the future. There will be direct federal payments to metropolitan cities and counties. All other units of government will get pass-through payments from the state of Michigan. So metropolitan cities and counties. Metropolitan cities are defined in the Act, in the ARPA Act, Section 603, subsection G, subsection 4. Don't get too excited because that's just going to have you go to another act of HUD to get the definition of what a metropolitan city is. It's kind of complicated, so we didn't want to talk about that here, but that's where you'll find it. We're not here to talk about the specifics of ARPA, just the accounting entries, just the debits and credits kind of thing, the single audit stuff, but not the details of the act itself. Treasury will be hosting future webinars for that type of guidance, which shouldn't be expected until about mid-May at the earliest. That's when the federal government will get some more guidance in for us. These entries, you don't have to write them down or anything. They're going to be coming out in a draft numbered letter soon. We could post that draft letter as early as tomorrow maybe, or the beginning of next week. It's going to stay a draft until we get more guidance from the federal government, but we wanted you to see what we're working on, and it shouldn't deviate too much from the draft. So just keep in mind the draft and these PowerPoint slides are not authoritative until we release the final form of the draft numbered letter. Next slide, please. Okay. So the revenue account you should use is 528 other federal grants. That should be familiar because that's the same one we used for the CARES Act. You could point it off if you wanted to distinguish between the CARES Act and ARPA. If you want to use a separate fund, we're not designating a particular separate fund this time. We suggest you use Fund 285, 286, or 287 if you wanted to put it into a separate fund. You don't have to put it in a separate fund. Next slide, please. Now the accruals are contingent on a few different aspects of when it will be recorded, when the revenue will be recorded, when it will be accrued. Just keep in mind that you can't accrue back any revenues before March 11th, 2021. That's the date the act became law. And officially executed, as you see in that slide there. Unlike the CARES Act, there will not be an application for this. Revenue will be recorded when received or deposited, or when the federal government gives notice of the amount to distribute. So there's not going to be a lot of applications like there were for CARES, and that's why this is going to be a little different. So slide 5, please. There'll be 3 primary things we're going to consider when booking the entries. The first one is funds availability, whether they're available in terms of GASB definition of available, whether the funds were received, and the costs or reduction in revenues were incurred. So the trickiest one of these is the term available. And what that means is is the money going to be collected after the end of the fiscal year, but soon enough thereafter to pay liabilities of the current year? So say your fiscal year is ended, are you going to collect revenues in time to pay this year's expenses and liabilities? Usually that number is 60 days. That's the most common time. So if you haven't collected the money by fiscal year end and your policy is 60 days, then you need to have that money collected within the 60 days in order to make it available. That's the first thing. The second thing is funds received, and that just means, did you get the money? Was it received? Is it in your hand? And the third one is, did you incur the costs as stipulated by the act? Because they're going to tell you you can only spend this money on certain things. Or did you have a reduction of revenues? So part of the stipulation in ARPA is, did you have a reduction of revenues for a particular period? So those are the things that you'll want to consider. Next slide, please. So here's the journal entries that we're going to start with. This is the most straightforward. This means you have received the funds, they are available, and you've incurred the reduction in revenues or the expenses. So then you just debit cash and you credit the revenue account. Pretty straightforward. Next slide, please. This next one is the same, except the funds were not received. That means they weren't received by fiscal year end. Since they are available, you receive them within the 60 days. So that's the little nuance there. So what the entry will be there is that you're going to set up a receivable due from federal, due from state, depending on if it's going to come directly to you or through the state, and you still can book the revenue on this one. So that's not really difficult, but it just hinges on when you receive the funds. So you would receive them within 60 days of your fiscal year end. Okay, next slide, please. Okay, same kind of scenario. The funds were available, the funds were received, so it's all received within 60 days, but you didn't incur any expenditures and you didn't incur any reduction in revenues, right? So they're not really earned. You just basically got the cash in advance of earning them, quote, earning them. So they sent you some money, and since this, you can incur these expenses way out until 2024, I think that's a little later. You may not have actually incurred the expenses that would qualify. So what you would do then is you would debit your cash and you would credit unearned revenue, so that in the future you can actually reverse out that unearned revenue and book a revenue in that case. Okay, so the next slide, please. Okay, so here is where the funds were not available. They didn't get received within 60 days of fiscal year, and the funds were not received at all, but you did incur the expenditures, the qualifying expenditures, or the reductions in revenue. So this one's a little trickier because you've qualified for obtaining them, you just haven't received them. So then you book the receivable from the state or federal government, and then you book a deferred inflow unavailable revenue, because it's really revenue, but it's not available to you. Available meaning within the 60 days. So let's say you got it 90 days from the day of your fiscal year, then you would book it to unavailable revenue. And then in the subsequent year, then you could book that revenue. This doesn't affect fund balance. It's just a balance sheet entry. It's not going to affect your income statement or your fund balance. It's just to record it on your books to let you know that you have some money coming in at some future point. Next slide, please. This is for the government-wide. All those entries that I just discussed were for the fund-based statements. The government-wide statements are a little bit different. And after looking at this several times, I think we need to disregard what's on the slide saying if the funds are not received within the period of availability. I think we need to just say for the government-wide statements, you can book due from federal and state government, and that this is assuming you have incurred the costs that would qualify or a reduction of revenue that would qualify, then you could book the due from, and then you would credit revenue in this one. I didn't put the entries there, but the credit would be to an actual revenue. I don't think there's any period of availability like there is in the fund-based statements. That's modified accrual, and we're not doing modified accrual. Okay, and I will research that, and if I'm wrong in what I'm saying, which wouldn't be the first time, we will correct it in the final version. Remember, these are not authoritative. We're putting out a draft, a numbered letter shortly. Okay, documentation. Next slide, please. What you need to do for these, if you don't get much federal aid, and we'll go down a few things, not only on this slide, but the next slide, but you have to make sure you keep supporting documentation. The ARPA will require periodic reporting. We don't know what this will entail at this point, but we recommend that you prepare accordingly and make sure you document your expenditures, document your reductions in revenues. Depending on the amount of expenditures that would qualify, you may have to have a single audit. We'll talk about that, I believe, in the next slide, please. Okay, a single audit is if you spend, not necessarily receive, it's kind of weird, but if you spend over $750,000 in eligible expenditures for federal aid. That would put you through the threshold of the single audit. Now, keep in mind, if you don't spend that much or receive that much in federal aid, you still have to comply with the requirements of receiving federal aid. You just don't necessarily have to go through the process of a single audit. A single audit is, and I do have a little bit of time to explain that. A single audit is, if you receive federal aid, you might think, hey, I might get a visit from federal auditors someday. The feds from Washington are going to come out and they're going to audit my books. Well, I think what they decided was that seems pretty inefficient. And what they want to do is have your annual audit firm just do the single audit themselves on behalf of the federal government. So whoever you have for your annual auditor is probably the ones that would do your single audit. However, not all annual auditors are qualified to do a single audit for you. So you have to check on their qualifications. Let me see, hold on a second. So a few things you'll need to do for a single audit is, obviously, you would need to pay a little bit extra for your audit because the single audit's a little bit extra work and you'll need to pay for it. The audit would be conducted in accordance with generally accepted government accounting standards. We call it GAGAS. So the audit firm needs to be qualified to do that. You need to comply with federal regulations in terms and conditions of your federal awards. We will hold a more detailed webinar on this, so you'll be able to have a little bit more information as we go forward. Some of the things that you'll need to do and track you'll need to have a financial management system to separately identify, track, and effectively control each source of federal funds. You'll need to have written procedures covering at a minimum allowability of costs, cash management, procurement, compensation and benefits. You'll need to establish and maintain an effective internal control over both your financial reporting and compliance with federal requirements. And like I said, in certain circumstances, you'll have to receive a single audit. So when you receive this this federal money, it's not with no strings attached. There is strings attached, and you have to comply with these items. Okay. Next slide, please. So just to recap, the three things that we're looking at for these entries is available. And we said that's usually 60 days after the close of the fiscal year. Did you receive the funds? Did you incur the costs, or did you incur a reduction in revenues? Those incurred costs and reduction of revenues, those will be defined more clearly as we go forward. We're not getting a lot of information from the federal government. but we will shortly. Next steps, just keep in mind, go slow. No decisions need to be made today, so take your time. Plan. Use this time to update your strategic plan or to develop your strategic plan if you don't have one. Some long-term considerations. The money doesn't have to be spent until 2024. Since revenues may be down for multiple years, do not make short-term decisions that put you at risk in the long term. Be transparent. Ensure to take full advantage of the public process by holding public hearings, discussing ARPA in newsletters and in public input tools. Financial stability. The future is uncertain. If anything we know today is the future is uncertain. So plan accordingly. That uses time to review your financial position. Some might not have enough reserves to handle unplanned events, and now is time to strengthen your financial position. So just be careful on how you intend to spend this money. Thank you, and that's the conclusion of my part. Veronica, back to you.
Thank you, Kerry. Next, I would like to introduce Bill Sanders. Bill is a senior auditor for the Municipal Finance section, and he will be discussing security reports and the borrowing process. Bill?
Good afternoon. Thank you for coming to the chart chat. As Veronica said, I'm a senior auditor in the Municipal Finance section. Our section monitors the issuance of debt by local governments and their general financial condition by reviewing qualifying statements, prior approval applications, security reports, and deficit elimination plans. My focus today will be on the security report and the changes made to this form. This will include going over what the new form looks like, what some of the revisions are, and where the report will now be filed. I will begin with our updated borrowing process flowchart. This flowchart gives a kind of a high-level overview of our borrowing process. Beginning in the upper left-hand corner with the qualifying statement. If a local government receives an approved qualifying statement and intends to issue debt, then the local government is able to borrow without further approval from the Department of Treasury. Please note that even though the local government can borrow without further approval from Treasury, that local government should always verify that the statute that they are borrowing pursuant to grants them kind of the authorization for the purpose of that borrowing. If a local government does not receive an approved qualifying statement and intends to issue debt, then they would need to submit a prior approval application. Now, a prior approval application is required for each debt issuance the local government intends to issue until the local government can submit a qualifying statement and a new determination is made. As you can see by this borrowing flowchart, security reports are submitted after the local government issues that debt there on the right hand of the screen. Next slide, please. The purpose of the security report, Form 3892, is to notify the Department of Treasury that the local government issued a municipal security and to provide further details on that issuance. The security report and accompanying information are due 15 business days after the date of the issuance. There are 2 statutes that require a security report to be submitted to the Department of Treasury, as well as what accompanying information are required for each report. Please refer to the Revised Municipal Finance Act, Public Act 34 of 2001, or the Agency Finance Reporting Act, Public Act 470 of 2002. In the following slides, you will see the security report has undergone some significant changes. The report now requires more detailed information to be included on the report. This has caused the report to go from a single page to 6 pages. As of March 1st, 2021, security reports are required to be uploaded online via our electronic filing system, and the department is no longer accepting security reports through email, fax, or mail. The electronic filing system is the same location where a user would upload a deficit elimination plan, file a qualifying statement, submit an F-65, or submit a prior approval application. And as these are posted online, we ask that these submitted reports be uploaded. Do not include like a copy of the check, any banking information, or other confidential information, because this is going to be posted online on our publicly available website. Next slide. As we have made changes to the security report, we have also issued a new numbered letter 2020-01, which is in regard to the revised security report. This numbered letter explains the purpose of the revision, which is an effort to fulfill statutory requirements and gather additional borrowing information. The numbered letter indicates some of the revisions that have been made to the security report. These include providing additional security details of the issuance, a checklist page for the submitter to verify all required documents are being included, and a payment voucher page. As the payments are still hand processed, the voucher page should be included with the filing fee so it may be properly matched to the security report that was filed online. If you have not used the electronic filing website, the numbered letter provides a quick explanation as to where to upload each security report submission. Once uploaded, the security report will be posted on our document search site. Until now, security reports were saved within our system, but not posted online. But as the state is moving towards transparency, the security reports submitted after March 1st, 2021 are now going to be posted online. For these to be posted online, the file needs to be properly named. Therefore, the numbered letter also provides instructions on the proper naming convention that should be used. This naming convention is the 6-digit Muni code followed by 3892 SEC RPT for security report. Next slide. If you have not already seen the revised report, these next few slides kind of provide a quick look. This slide shows the first page of the revised security report. Minor revisions include what act the report is being filed under, such as Public Act 34 or Public Act 470, and if an exemption was required and what type of exemption that may be. Next slide. Page 2 requests more information regarding which local governments are responsible for repayment of the security, and now requires one to provide information to the most recently submitted qualifying statement or qualifying statement reconsideration. Next slide. Next slide. The form is now requesting more information as to the structure and the type of the issuance. For example, if the issuance is a capital improvement bond, you will need to provide the date of notice of intent was published for that capital improvement bond. Next slide. We've tried to encompass and include the most common forms of municipal securities. We understand that there may be others that are not included on this form. If there's a scenario where the issuance does not fall into any of the types given in our form, you could select other, which is under the bond section shown on the prior slide, and submit an attachment to the report providing information as to why that particular security does not fall under any of the options that we have listed. Next slide. For this slide, page 4 of the report, provisions here include information as to the rating, if one is required, information to the local government's outstanding debt, and if this issuance puts the local government over its debt limit. Next slide. To help ensure with ensuring the submission includes all the documents as required by statute have been included with the report, we have added a submission checklist page for attached forms here. This should help reduce any of the back and forth of requesting missing information from local government, and again, make sure the local government is compliant with state statute. Please note an explanation is required if a document was not needed or included. Any explanations indicating why documents are not included should provide more detail than just not applicable or not required. We know not all documents may be required, but as these are posted online and for transparency purposes, the responses should be clear as to why specifically the documents are not included. Again, the department may deem the security report to be incomplete and may not be accepted if all information is not submitted or if the user did not provide an acceptable explanation as to why a particular document was not included. Should the department deem a security report to be incomplete for either of these reasons, this may cause the local government's submission not to count towards the 15 business day requirement and may result in a subsequent year denial of the local government's qualifying statement. Next slide. Finally, the last page of the report is a payment voucher. This form is only applicable if you are filing a security report under the Revised Municipal Finance Act, Public Act 34 of 2001, subsection 319(1), or in other words, had approved, if you had an approved qualifying statement and you didn't need to file a prior approval application. The filing fee check should match with the payment voucher and should be mailed to the address provided on that voucher. A question has been asked when submitting this form, what should be indicated on the submitter line? This should be whoever is paying the filing fee. Sometimes it's the local government pays directly, other times the bond council pays on the local government's behalf. This helps cross-check and match documents to each other. And just again, as another reminder, just do not include a copy of the check with the submitted information, as these documents will be posted online. Next slide. The next few slides provide screenshots on how to get to the electronic filing system and how to upload a security report. You would go to michigan.gov/treasury, and under local government on the top, you would select community engagement and finance. Next slide. Under community engagement and finance, you would select file online reports. Next slide. And finally, you would be on our electronic filing system login page. If you do not have a user ID, you would select request access new user to create a user ID, whereby you would then create a profile. Once you have that created, or if you already have one, then you would enter your user ID and password, enter the security code, and then select login. Next slide. Once logged in, you will see this page. This is where you will select the appropriate information and the type of form you're being submitted. For presentation purposes, see security report has been selected. Once this is done, just select create form. Next slide. You will see the local government basic information at the top of the page. This shows for whom this report is being filed. If the information is correct, you will upload your file below. Select choose file and select the file, making sure it has the correct naming convention as we had discussed previously. This should be a single PDF file. Next slide. Once selected, you will see the selected file to the right. If incorrect, you can select choose file again and select a different file. If you do this, the system replaces the file previously selected. Once you have the correct file, click certify and submit. Next slide. You will need to click a box to certify the Chief Administrative Officer, or also known as the CAO, is aware of the security report being submitted. We understand that the CAO is not usually the one filing a report. However, we do believe it is important for the CAO to acknowledge what is being filed on behalf of the local government. We do know that the CAO's knowledge about the submission of a security report can vary considerably, but they should be aware of what is being filed. Once you check and certify, click Submit. Next slide. Once submitted, you should see successful submission at the bottom left side of the screen. If the local government has more than one security report filed, you would need to go through that process again. Next slide. That concludes the security report presentation of the chart chat. Here's our contact information for municipal finance.
Thank you, Bill. Next, we will have Nick Brousseau, an analyst with the Community Engagement and Finance Division, who will be sharing information about using net position as an indicator of fiscal health for local governments.
Thank you, Veronica. Again, my name is Nick Brousseau. I'm an analyst with the Analytics and Outreach section in the Community Engagement and Finance Division, and I am here today to talk about financial metrics, fiscal metrics, and specifically this presentation is going to be on long-term solvency and the net position ratio. So this is the third part in a series of webinars that we are discussing financial metrics and how local governments can use these metrics and other tools to keep an eye on their fiscal health of their local government. Next slide, please. So before we go into too much of what my net position ratio should be, or how do I improve it, first I want to make clear to you all of what both net position is and what the net position ratio measures. So in the description here, generally net position is the difference between a local government's assets and liabilities, assets plus deferred outflows of resources, and liabilities plus deferred inflows of resources. Just to expound on this a little bit, assets generally refer to cash and investments, accounts receivables, inventories, capital assets, prepaid items, among others. Liabilities refer to accounts payables, salaries, and related benefits, funds due or from other funds, compensated absences, deferred compensation, pension and OPEB liabilities, and other debt. And then the two other sort of components of this are deferred outflows and inflows of resources. Generally speaking, what these refer to, outflows are generally referring to funds that have already been expended, that are scheduled to be reimbursed but will occur during a different reporting period, or in the case of inflows, funds that have been received but will not be spent until a different reporting period. An example of this are grants that a reimbursement grant, you may have spent the money for that grant project, but you will not be receiving the reimbursement until a different financial period would be an example of outflows. An example of inflows would be grants that you have received a grant for a project but not have yet expended those funds. And then that net position ratio number is that net position, so assets minus liabilities generally, as a percentage of your governmental revenues, so divided by that number. This ratio is useful in gauging long-term solvency of your local government. So the ability of your local government to continue to afford any sort of long-term debt or other financial obligations while continuing to provide essential public services that your local government needs to provide. Our intent here is not to indicate that debt is bad or good, but on the contrary, debt can be a useful tool for local governments to advance and leverage resources over time. The main issue occurs when local governments have excessive debt and it becomes a drag on their resources and prevents them from being able to provide public services now. So the point here is to evaluate the net position ratio and find a balance that works both in the short term and long term. Next slide, please. So this is a quick overview of how you would find this number. The net position, which is the numerator, you can find in your statement of net position under the governmental activities column. Total governmental revenues can be found in the statement of revenues and expenditures and changes in fund balance under the total governmental funds column. Dividing those two numbers will give you your ratio. So in the case of this local government, it is 20.4%. Next slide, please. So now we know what the net position and net position ratio are and how to calculate the number. What should that number be? The answer to that is complicated, and it really depends on a number of factors on a community by community basis. So when looking at your net position ratio, it's different than the general fund ratio that we've discussed previously, or the cash ratio that we discussed on another presentations, in that the net position ratio is over a much longer period of time, and it's typically much more difficult to make immediate changes to this metric. We've listed here a number of items that local governments can do to improve this number. I'm not going to go through them all, but take a look at these are generally ways in which you can improve this metric. So before I move on, I just want to quickly explain what the numbers mean. So if you have a net position ratio of 0, that generally means that your local government's assets are equal to its liability with nothing left over. If you have a net position ratio of 100%, that means that your net position, assets minus liabilities, is an amount that is adequate to cover 100% of your government's annual revenues. On the other end of that, if you have a net position ratio of -100, that means that the net position will consume 100% of your annual governmental revenues. So the amount left over you would need to use an entire year's worth of governmental revenues to cover what is left over in that net position number. So the reason for negative numbers are largely in part to requirements implemented as part of GASB Statements 6768 and 7475, which require that pension and OPEB liabilities to be included in your local government's audited financial statements. Next slide, please. So conventional wisdom says that any number greater than 0 is generally a good thing. So with that said, we have a poll that we're going to put up in the chat of what do you think your local government's net position ratio should be. We'll give a couple seconds, 20, 30 seconds to complete this, and then we'll take a look at some of the statewide information. Just a 10 or 15 more seconds, and then we can take a look at the results. All right, let's take a look. So most of you said somewhere, the majority said somewhere between 50 and 100%, with answers scattered throughout from 0 to 50%, all the way up to 200 to 250%. Next slide, please. So what this slide shows is what the statewide medians are for different types of local governments throughout the state. So we saw on the, you all selected from the poll of what you thought the statewide median would be. So depending on your local government type, you all may be correct. The ratios range from over 250% for townships and villages to 39% for counties. So it's important to take a look at what type of local government you are when calculating this ratio. Next slide, please. And we had mentioned previously that one of the factors for a decrease in net position ratio was due to pension and OPEB liabilities being included in the financial statements. This takes a look at what the medians are for local governments that have pension and OPEB liabilities versus those that not. So even for those with higher median net position ratios, the difference is significant from those who have pension and OPEB liabilities versus those who do not. So this is another factor to keep in mind when you're evaluating your local government. Make sure that you take into account what sorts of services you provide and what sorts of benefits are offered. Next slide, please. And another piece of data that take another sort of metric or criteria to look at when you're evaluating your local government is the population size. So obviously, those local governments that are larger tend to provide more services or services to a greater number of people, so that may affect their median net position ratio. So another metric to keep in mind when you're reviewing this number for your local government. And then next slide. And then finally, we take a look at what the bottom percentiles of local governments look like. So these are just for sort of informational purposes, and when you're evaluating your local government, make sure to take a look at where, what type of local government you are, along with other factors related to your local government to gauge where you should be at related to this metric. Next slide, please. So when you are using Treasury as a resource to look up your net position ratio or other metrics, the Michigan Community Financial Dashboard is a good tool to do that. It provides this metric along with many others. You can access it from www.michigan.gov/CEFD. And you can access this and compare your local government to other local governments, among other things, on this page. Next slide, please. And then before we move into some of the questions at the end, I just want to take a quick moment to plug some of the trainings that we have coming up. So Fiscally Ready Community Trainings is a training series that Treasury hosts with MSU Extension. We have, you can see the dates here. We have 2 different training types that are going to be hosted this year, budgeting for fiscal sustainability and capital asset management and planning trainings. So you can access these again from michigan.gov/CEFD, or you can use the link in the PowerPoint to access that. Next slide, please. All right, and then finally, just have some contact information. I mentioned some of this previously in these slides, but just for your information, these are how you get in touch with us or access some of these resources that we talked about during this presentation. With that, I will turn it back to Veronica to take us out.
Thank you, Nick. So we're now going to start the question and answer portion of the webinar. So at this time, please use the Q&A feature to submit any questions that you may have. And I'm going to start the Q&A section by asking some questions that we have received via email before the webinar. The first question is regarding the American Rescue Plan Act. Does Treasury have information on specific uses for the American Rescue Act funds? So far, everything has been too vague to act on. And to answer that question, I'd like to introduce Rod Taylor, who's our Division Administrator of the Community Engagement and Finance Division. Rod?
Thank you, Veronica. Yeah, that's one of the questions that obviously many of us are waiting to get a more detailed answer on. And unfortunately, at this point, we do not have any additional guidance from the Treasury on ARPA other than local units of government should make sure that they have a DUNS number as well as have an active SAMS number. For most of our local units of government, they would have already done this as part of the CARES Act dollars that they received. But as a reminder, the CARES Act, the SAMS registration has to be renewed on an annual basis. We don't expect to receive additional guidance from federal government on how to utilize these funds. Another question that was asked in the Q&A was a question on more guidance on how reduction of revenues will be calculated. We don't anticipate hearing anything from the feds until I believe their 60-day deadline is May 10th. So we wouldn't anticipate hearing anything until probably close to that date to answer those questions. As Kerry mentioned earlier in the presentation, though, we do plan to have a additional webinar specifically on ARPA. Once that guidance comes out, it'll be part of our Tools and Resources webinar series. So make sure that you're signed up for our Gov Delivery service, our email blast service, to make sure you're notified of that information. Veronica?
Thanks, Rod. This next question is also regarding ARPA. For the American Rescue Plan projects, is the state of Michigan going to request that we use certain activity numbers? And Kerry, could you answer that question?
Sure, thanks, Veronica. Certain activity numbers would be, that implies expenditures because you don't have to use activities for revenues. I know that some of you do use activities for revenues, but let's set that aside. No, it wouldn't have any unique activity number for your expenditures. You would use the same ones you always do. Like, for example, if you're putting in a sewer system or you have essential worker premium pay, it's the same activity that you would use for those, but make sure you track those because those are looking to be eligible for reimbursement, so you'd have to track them, but there's no special activity number to use for ARPA.
Thank you, Kerry. This next question is also for you regarding the chart of accounts. So the question is, I've noticed that the chart of accounts was requiring a separate account number for all fringe benefits, but the version on Treasury's website currently is showing personnel services sub-control account 701 used solely or as the total of 701 through 725. My question is, are we allowed to have different accounts for different types of wages and fringes as we choose, as long as the accounts are in the 702 to 725 range? And if so, do we need to have a 701 sub-control account to set up to roll the totals up into?
Okay, thanks, Veronica. If you're using the detail, you don't need to necessarily have a 701 to roll them up into, especially with the computer systems of today. Back in the old days when I started, you would roll those up on your general ledger, and then you would have the control amounts being used to make reports, but that was a million years ago in the Stone Ages. So these days, not necessarily. A very, very small unit might just use 701 in very rare cases. But it sounds like you want more detail. So what you would do, and it sounds like you went to, let's see what page it is, page 32 of our chart of accounts. And at the top of 32, the 701 through 9, yeah, 701 through 9 is for salaries and fringes. And the 710 through 9s, those are the fringe benefits. So you can use 701 through 702, don't use 701. You can use 702 through 709 for salaries and wages, and you can use any type of breakdown you want for those. And then you could use 710 through 719 for fringe benefits. And there's some examples there for fringe benefits. It's like hospitalization insurance, employee life insurance, and for the salaries, you've got supervisory, permanent, appointed officials as an example of what you can use. So use those ranges for those particular entries. I hope that answered your question.
Thank you, Kerry. I'm now going to turn it over to Rod to lead us through some of the live questions that we've received. Rod?
Thank you, Veronica. So our first question is for Mike. Mike, the question is, so we don't have to capitalize items if the individual cost is less than the threshold, but as a group of assets if it's over the threshold.
Correct. So if you've got a group of assets that you're purchasing, you can do either way. So if you purchase a group of assets, say you get, the example had 40 computers for $700 a piece, $28,000. You can capitalize that as a group of assets. GAAP allows you to do that, but you'll need to track those assets individually. So each year you should be doing a physical inventory to make sure you still have 40 computers. You know, if one of them goes bad, you know, in year one, and you got to toss it, you should be recording an impairment. From a theoretical standpoint, you should be recording an impairment there. The answer is yes, you should. You can do it both ways. The easier way of doing things, if you've got a smaller dollar thresholds, would be to just expense those off, because you know, you're grouping, you know, 40 computers. Instead of saying, hey, I've got 40 computers here, I'm going to say I've got one computer worth $700 and I'm going to expense it. So there's some leniency there, but you know, generally speaking, in my opinion, it's better to just expense those off.
Okay, thank you. The next question, I'm actually going to try to answer myself. And there's two questions related to the payroll, public safety, public health, payroll reimbursement program, and what is the status of the release of those funds. If you're not aware, back on March 23rd, our division responsible for administering that grant, ORDA, posted on the website the current prorated amounts as of March 23rd. They wanted to make sure that local units of government were aware of what those current numbers were, and if there were any missed items or discrepancies, to notify them. They are still going through their final audit phase to make sure that all the local units of government that submitted grants are on that list and have the appropriate numbers. I don't have a specific day or time on when it's expected for those final payments to be released, but I would expect that they are getting very close, and we should see those certainly more in the near future than we've been expected to see to this point. So be patient, it's coming. They just have a lot of work to do to finish that up and to make sure the numbers are 100% accurate. The next question, I think, Kerry, you may have already answered this one, but this goes to you, which is, we have a number of year ends that local units that have a March year end, and as it's related to ARPA, should they be considering booking this as a receivable, even though federal government hasn't released final specific numbers for how much local units of government will receive? And if you're a non-entitlement community, it may be until as late as August or September before they receive those funds. So how should they handle that if they are a March year end?
Yeah, if you don't know what the amounts are, we don't know what's going to qualify. We don't know the period necessarily of a reduction in revenues and what that is compared to. So there's just too many unknowns at this point to book anything. So we have to get more information in order to determine whether you should book a receivable or not. I think maybe after May, when we get more information, you'd be in a better position to book some receivables.
Okay, Kerry, I'll stay with you a minute. Single audit. Is the total amount you're receiving is over 750, but suppose it's in two parts in two different fiscal years. Can you remind us again on that threshold of when that 750,000 applies?
Yeah, and just be careful. It's an oddity of the accounting world. I don't know why, but it's how much you spend. It's not how much you receive. So if you have eligible expenditures of over $750,000, I mean, in theory, you'll be getting $750,000 back, but it's based on expenditures, and it's in. Correct me if I'm wrong, Mike. You can get in here if you want. It's in a single year, I believe. I'm not 100% on that. Mike, do you know?
Correct.
Okay, single year, single fiscal year.
Mm-hmm. And again, we will have another webinar specifically on ARPA, and again, we'll cover more details of the single audit, also known as the Yellow Book requirements. And so we'll make sure that if we don't have the answer exactly correct, we'll make sure we have it 100% correct in the next webinar. So we are about 5 minutes over, so I'm going to finish here with one question back to you, Mike, and this is again related to capital assets. What about roof repairs? Should they be capitalized or treated as maintenance?
This is kind of a judgment call as well. If it extends the life of the building, then yeah, you would capitalize it. If you think it'll extend the life of the building, say from 40 years to 60 years, you would capitalize that. But if it's just going to keep the maintenance, say you got to replace the roof every 20 years on a building and it's a 40-year building, you're halfway through, you would record, in that instance, you would record it as maintenance.
Okay, thank you. Veronica, I'll turn it back over to you.
Great, thank you. Thank you everyone for joining us today, and thank you again to all of our panelists for this discussion. We hope that you have found this information helpful. There is a survey that will auto-generate after this event, and we would love if you would take the time to fill that out. That helps us know whether this information was helpful, what other information we can present in the future. So we would appreciate that, and stay tuned for upcoming Treasury webinars. And again, thank you for joining us.